I'm with Gary Reynolds, Chief Investment Officer at Courtiers, to find out a little bit more about the Courtiers multi-asset funds. Gary, we often talk about what's in the funds, what's not in the funds. What I'd like to look at is the construction of the funds. How are they actually put together and maintained? Now, there's plenty of this information on our website, but what I'd like to do is focus specifically on the risk controls, if we could.
Sure, Leo, sure.
Great. Okay, well, if we begin with diversification, tell us about geographical diversification.
Well, if the simple phrase that explains diversification is don't put all your eggs in one basket. So geographical diversification is don't put all your eggs in one country. Now, there are different levels of risk. So it is generally accepted that if you invest in developed markets in the West, you're carrying less risk than, say, if you invest in an emerging market or somewhere like Taiwan, which has got certain geopolitical risk. But even in the West, you can get economies that can be badly affected. And a very, very good example of that recently is when Putin invaded Ukraine, Germany lost its source of very, very cheap energy. So it affected the economy and it affected German companies. So if you've got everything in Germany, you're going to be fully subject to those risks. But if you've got some in the UK, some in France, some in Germany, some in Japan, some in the US, some in Brazil, some in Mexico, and so on, which more describes the way in which we invest globally, then you are reducing your risk.
Onto sector diversification. Sectors, different investment sectors. What are they?
So sectors are defined as certain parts of the stock market where companies have similar characteristics. So pharmaceuticals is clearly the companies that produce drugs. Banks are the companies that provide finance. In the UK, your Barclays, your Lloyds, your NatWest, your HSBC. So the point of diversification with regard sectors is don't put all your eggs in one specific type of company. So you didn't want to be going into the global financial crisis with a portfolio that was 100% in banks. And what we try and make sure we do is that we diversify across sectors as well as across countries.
Perhaps not so clear would be factor exposure. What exactly does that mean?
Well, certain portfolios are driven by some factors more than others. So I'll give you an example of a factor would be interest rate exposure. So we can test, by stress testing the portfolio, we can work out how our assets respond to an increase or a decrease in interest rates. But there's a number of other factors that you would take into account. The value factor, the growth factor, small cap, large cap. These are all different factors. And again, we try and make sure that we are not overly exposed to just one particular type of factor.
Within all of this diversification, risk hedging, is it sort of parallel to diversification, if that makes sense, or do you diversify your sectors first, then you start looking at risk hedging as a sub-layer underneath that? Can you explain a little to us about downside protection?
Yeah, so part of the stress testing will be looking at certain scenarios and how does the portfolio respond to certain types of scenarios. So you might be looking at how does the portfolio respond if there's a repeat of the global financial crisis? How does the portfolio respond if there's another tech bubble that bursts? How does the portfolio respond if there's a crisis with the dollar or American debt? How does the portfolio respond if we get a repeat of the pandemic? And then we look at ways in which we can minimize the effects of those downsides. And there are a number of ways of doing it. And I'll give you a very good example of how we approached the pandemic in 2020, because the pandemic was not expected. You know, it was 100 years, over 100 years since the previous pandemic. So this is not something that you expect to pick up every day. And it's reasonable to assume, with the way in which pandemics affect the human race, that loads of people are going to live their life without ever having to deal with a pandemic. You know, my mother would be a case in point, born in the late 2020s, died just before the pandemic hit. She never experienced one. But you've got to be mindful of what happens. But as we entered the pandemic, what we said on team was, look, you've now got to look at every single asset, every single company, with the pandemic in mind. Can it survive and then thrive? So we then go about getting the risk reductors in place at a very, very granular level. So yes, Leo, it is multi-layered. And if I then just add one more thing, where we can, we'll use derivatives, not to shoot the risk up on the portfolios, but to reduce them. And we were in 2006 the first company in the UK fully approved by the FSA to run all our positions if we want to through the use of derivatives. So we have a lot of experience of that, and the fact that the funds have got great risk return statistics over the long term is partly because of the use of those derivatives, reducing the downside.
Which is the other part of the risk hedging, is the derivative overlay.
Yes, the derivative overlay, absolutely.
Okay, Gary, let me jump around the page onto scenario analysis. Stress testing sounds quite interesting. Talk to us about that and how it fits with what you've already explained to us about diversification, risk hedging. How's this all working together to create secure investments with a long-term view in mind?
Yeah, so it's a thing called stochastic testing, where you create a model and you stress it with a change in a number of environments. So I like to take the testing from actual scenarios. So the ones I mentioned earlier, tech bubble bursting 2000-2001, global financial crisis 2007-2008, American debt crisis, Euro crisis, all these things. And then we say, if they happened again, what would occur? We look at the outcomes, and if we think that the downside, which, these are still, our multi-asset funds are not risk-free, we never pretend they are, they will wobble, but they'll wobble to different degrees compared with the market. Then we look and see, how is this portfolio responding? And if we think it's responding too much, we look and we find out why that is, and then we may take some assets out and replace them with something that's less responsive. And I like that, because when our clients can see that analysis on their portfolios, and it gives them a real feel for how will this portfolio do if something goes horribly wrong.
Liquidity assessment. What does it entail? Why do you do it? And what are the outcomes that you ensure?
Vital. Liquidity is vital. You need to be able to access at least a large part of your assets quickly. So we're constantly testing the liquidity. Because our clients are long-term investors, we can hold a little bit of a liquid asset. So, give you an example, shares in Shell are, under all normal circumstances, a lot more liquid than the assets we hold in infrastructure funds, which might be invested in schools and bridges and power cables. You can't sell those as quickly as you can sell Shell shares. So there's a difference. Now, what we test is how fast can the portfolio be liquidated, and that is a test that's run regularly within team, and we maintain very, very high levels of liquidity. Now, there's a thing that has applied in the past in the financial sector to funds called a dilution levy. And that basically means that if clients are exiting your funds and taking money out, then if that's detrimental to the remaining investors, you have to apply a levy on that withdrawal to protect those that are staying in the fund. In other words, if you're leaving the fund and I'm staying, then the fund can't give you my liquidity and to my detriment. We have never had to apply a dilution levy since the funds came into being. Despite the global financial crisis, the pandemic, never had to do it. And that's because the liquidity is managed very, very carefully.
And Gary, what stands out here is the investment strategy risk return analysis, the ISRRA. Now, I know that that's a piece of in-house built software that's been built on for many years. Can you give us a snapshot When did it start? How's it evolved? What can it achieve now? And surely there's future ambitions and objectives for the ISRRA.
Well, it's been running in different guises, I guess, for 20 years. And probably, I think 2011, the current version was sort of put out there. What we wanted to deal with the issue of making forecasts for clients. Now, the traditional way of making forecasts is to say, oh, your portfolio is probably going to grow at 5.5% per annum, and you get this linear growth all the way through, looks absolutely splendid. And of course, it will bear no reality to what the actual path is that the client suffers. The gold standard for forecasting is the fan chart system used by the Bank of England. Because what that says is, well, look, this is the average expected return, but the returns could be much higher, but they could also be much lower. Those lower ones are very important because it brings to mind to the client the possibility of being down there and therefore not being able to fund all their future lifestyle, their holidays, their car, their payments for grandchildren, school fees, presents to relatives, etc., etc. So that fan chart system is vital, and clients that have seen the ISRRA will know that it gives you this range of possible outcomes. Now that's bang in line with what the Bank of England believes is good practice, and we brought it into the systems for use by our clients. And the good thing with that is, particularly with Consumer Duty being around now, which is the new level of regulation that's coming, it's all focused on client outcomes. And what's great for us is that ISRRA is entirely about helping an investor achieve their goals in the lowest risk possible way. And it's been a very effective tool.
And we consider multi-asset funds we're talking about here, 5-year performance, 10-year performance of the cautious, the balanced and the growth.
Yeah, but they've been going longer than that. They go back to sort of 2007. So this client's been in them since the year dot. They're very, very happy. I know that, I see them regularly. Possibly if you put money in the funds in January 2023, you're not so happy because, the absence of a big weighting towards US tech has meant we've not performed as well as the racier funds out there. So we've dropped below average. But if you look at our risk-adjusted returns, in other words, what return do we get for each unit of risk we take, which is the holy grail within the industry? We're top quartile over 10 years on all the funds. That's where we want to be. I'm happy with that. That's doing our job.
And these risk controls are just part of a well-established, refined, tested, rigorous fund construction and management process and framework that surely it goes some way to say how you couldn't just pop one of the Mag 7 in for 6 months while it's doing very well.
No, you can't do that. Look, people have been in the fund 18 months. I sympathise with you because I'm sitting here saying the long-term returns are great, and they are. So if I'm talking to clients that have been with us for a very long time, they're happy. If you're talking to the clients that have come new to courtiers in the past 18 months, they're scratching their heads and thinking, hang on a minute, guys, you're below average at the moment. And that's true. But the deal from us is we will not chase the bubbles. That means when a bubble is being blown, we're going to underperform. But we will never chase it. So this is what you get from us. You're not going to find yourself waking up one morning 100% invested in US tech and having the bottom blown out of your wealth. That's not going to happen. But it does mean you've got to accept that when certain sectors are racing away, and that's what the market's chasing, we're not in them. So I can't go in them because of the risk constraints that we promise investors. And that's the same. Now, look, let me say, if anybody's out there and they're so inclined to go and buy Apple, Alphabet, Amazon, Microsoft, Meta, Tesla, Nvidia, 7 very liquid US stocks, buy them. I'm not recommending it, by the way. I would not do it. They're too expensive in my book, but you can go and do it. So if you want the fun on the side and you think we're wrong, you can do it, but you've got to take the consequences. And look, in 2022, it was pretty dire. Some of those stocks got whacked.
I just want to bring it back to the risk controls, Gary, and the reason we looked into this and the multi-asset funds. Underneath risk parameters, we have beta limits, and this documentation explains to me that a beta is a measure of the volatility of a security or a portfolio compared to the market as a whole. Each fund has a theoretical beta ceiling derived from assumed equity and bond market betas. Can you say that in a way that I understand?
Yeah, so beta 1. Market moves 1%, you move 1%. Beta 0.5. Market moves 1%, you move 0.5%. Beta 1.5. Market moves 1%, you move 1.5%, up and down. So bigger betas, more risk.
Delta adjusted equity exposure then, Gary, sensitivity of a portfolio to changes in prices of the underlying securities.
So assume we got 100 million. I've put 99 million in cash and 1 million in FTSE 100 options. Assume those FTSE 100 options are going to move at 20 times the rate of movement in the market. So market moves 1%. The options move 20%. So I've got 1 million in options. They move 20%. That means, as it's 1% of the portfolio, I've got a 0.2% movement. So you can then work the delta back from that and say, if I had this 1 million invested in options, it's the equivalent of having 20 million invested in the FTSE.
What exactly is mean variance analysis?
It's measuring the extent to which all your assets move in the same direction. So a simple example. Let's assume that I've got a business on the south coast and I own 20 ice cream vans. Bad weather, all in the same area. Bad weather, my sales will drop. So that I'm very exposed to the climate. But what if I had 20 ice cream vans or 10 ice cream vans and 10 umbrella stalls? Then it rains, I sell less ice cream, but I sell more umbrellas. The more balanced, lower risk portfolio is the umbrellas with the ice creams. The more concentrated, the one that won't have such a good outcome for mean variance is all ice creams. And we test that across all the stocks.
So we're looking at the multi-asset funds, but do these measures apply to all of the Courtiers funds, or are there different ways that you look at, say, the equity and the bond?
No, you have to deal with the pure equity, pure bond funds in a slightly different way, because you can't buy other assets. You can't buy anything but UK equities for the UK equity fund. So by definition, I've got no dilution we don't dilute the geographical risk. So what we then look at is how we spread that risk amongst the number of shares in the portfolio. But the way we control that in those funds is that they're equally weighted, and we try and maintain a minimum amount. So there's always a very, very good spread. But it's not the same with we run the scenarios and things on them, but you can't use a multiple of assets to spread the risk. They're by definition more concentrated.
Sure. So clarity, we've looked at the multi-asset funds. You've given us a little insight into the equity funds and the bond fund. We'll revisit those in another video in more detail at some point.
Very much.
We'll leave it there, Gary. Thank you very much for your insight.
Thank you, Leah.
Thanks to our viewers. If you do have any questions, please speak to your advisor, and we'll look forward to catching up again soon.